Hello everyone, Kieran King here. Today I'm going to talk to you about crowdfunding. History tells us that a group of people aligned in thoughts, philosophy, action, or anything can really have a seismic impact on the world. The power of the crowd, the pooling of resources, is what has started revolutions and overthrown empires. So what is crowdfunding? Well, it simply means that using the crowd or a group of people to fund or give money to something. This could be a cause, a business, an NGO, someone's pet. And although this could be a charity and donation based, what I'm going to talk to you today is more about the business side. And generally, the crowd, in exchange for their funds, would want something in return. So this brings us to broadly two types of crowdfunding. You have reward-based crowdfunding, and you have equity crowdfunding. So, reward crowdfunding is when a business will pre-sell a product or service in order to gain money to launch said product or service. So, for example, let's say a business wants to launch a product. Let's say they want to launch a jetpack, and let's call this company Why Drive When You Can Fly.com. And they want to launch this jetpack for everyday people to commute to work with. I'm just keeping it fun, okay? Anyway, they have a prototype, but in order to get the necessary resources to build this thing properly and to distribute it, they need funding. And so they say to a group of people, they say, give us £1,000 to pre-order your jetpack. You will be the first to have it when it launches, and you are also buying it at a discount or something like that. They raise £1 million from 1,000 people. They build 1,000 jetpacks and then distribute them to those funders in a few months' time. Now, this is pretty neat, as they have essentially got the capital they need without incurring any debt or sacrificing share equity. And not only that, they also have 1,000 people now flying to work every day, which acts as great brand awareness for them. However, not all businesses can pull this off well, and if you think about it, you most likely need to have a very desirable or sexy product that people really, really want, and you need a platform or a network of people to also go out to. For funders and people funding this thing, there is no guarantee that the business may succeed either. Some examples of reward-based crowdfunding include movies, inventions, research projects. The list really goes on. The second type of crowdfunding is known as equity crowdfunding, and it is an area that I'm actually professionally involved in. This is where, in exchange for funding, funders will receive shares or equity in a business. What is equity? Essentially, equity means ownership in a business. Let's say, for argument's sake, a crowd of people invests £100,000 in a business in exchange for 10% equity. This means that the crowd collectively now owns 10% of that business. And if you, as part of the crowd, say invests £10,000, you would own 1% of that business. I hope you follow me. And hopefully that business will grow in value, and over time, your 1% that was worth £10,000 might later be worth £20,000. It might also be worth zero, but that is what investment is. And why is this even a thing, and why has it blown up in recent years? Well, in the past, to invest in private companies or startups as an angel investor, you generally needed a larger sum to invest, say £25,000, to make it worthwhile for the business raising funds. And you, of course. However, by utilizing crowdfunding and the power of the crowd, which collectively can raise £25,000, the amount needed to invest for one person can be much lower. And this allows more people to participate. And you could call this the democratization of investing in private companies. For example, you could potentially have 25,000 people invest £1 each instead of one person investing £25,000. I hope you follow me so far. Now, businesses can benefit from having lots of shareholders, as they are more likely to spread the word, increase brand awareness, etc. However, businesses tend not to like to have too many singular shareholders on their cap table due to the amount of admin needed to administrate them, take their votes on key issues, and stuff like that. So that's where a very clever thing called a nominee is put in place. And a nominee is a legal structure that basically acts as the legal owner of all the shares on behalf of the beneficiary individual shareholders in a crowd. So let's go back to our jetpack company. If 1,000 people invest in our jetpack company for, say, 10% of the business through a nominee structure, that nominee will be the single legal shareholder of the business, and will do the admin and voting and all those things for those 1,000 people who invested, which ultimately will receive any return on their investment. This means that our Y-Drive and YouCanFly.com company has one main legal shareholder on their cap table, but they still get the reach and ambassadorship of having 1,000 beneficiary shareholders. So it's essentially the best of both worlds. Okay, hope you get me. Another variation of equity crowdfunding is called debt crowdfunding. And here, instead of getting equity in a business, you will get an IOU, or relevant debt security, that the company you have given money to will owe you back plus interest over time. But that's another story, and we might go into that another time. So to summarize, we have two types of crowdfunding in the business world. We have rewards-based and we have equity-based. There are plenty of websites out there for you to take a look at, and you can always check the one that I work with as well. Just let me know and I'll send you a link. But do remember that when you do invest in companies, especially private companies, your capital is at risk. Anyways, if you have any questions or comments, please leave them on this video, and I will do my best to answer them. Take care, everyone. Talk soon.